The miners' rise sending the All Ordinaries Index up. The RBA cut interest rates again in a desperate bid to get things moving, whilst the announcement took its toll on the banks. Hello and welcome to this week's Australian Stock Market Report. I'm Dale Gillham, Chief Analyst here at Wealth Within, and we are Australia's most trusted stock market educators. Now before we move on, hit that subscribe button down there below and click the bell on the right of it so you keep up to date with our latest videos. Also remember to tune into our live Australian Stock Market show every Tuesday 7 to 8 p.m. Australian Eastern Standard Time. This is the show where you get to ask us, the stock market and trading experts, to look at your favourite stocks and answer all of your questions. Well, they did it. Last Tuesday, the RBA announced yet another interest rate cut, which appears to me to be a Hail Mary attempt to stimulate the Australian economy. Successive interest rate cuts in an already very low interest rate environment is, in my opinion, like trying to do something in a desperate hope that it actually might work. As we all know, rate cuts are designed to stimulate the economy and increase growth via stimulating investment. As it's cheaper for both consumers and businesses to borrow, so they spend more. But when rates are already low and things are not moving, you do have to ask whether the interest rates are really the issue, or is it something else? Maybe it's the fact we've had a new Prime Minister roughly every 18 months who has a new direction and new policies that has caused the issue. Business and consumers have lost confidence and they are making short-term decisions rather than risk getting caught in the shifting sands of Australian policies. That said, I'm not saying that a drop in the RBA rate is not good for our economy, as all rate cuts can be good and bad for Australian companies, as it affects our currency. Companies who export deal in US dollars, such as the banks, biotechs, miners and other material companies, will benefit from the rate cut. Those importing goods and services, however, will find it harder as it becomes more expensive to do business abroad, and a lower interest rate is likely to affect manufacturers and consumer stocks. Now, America is a really good example of what low interest rates can do to an economy, particularly as we saw the momentum of the US economy was slow to take off. Right now, I don't think lower interest rates will do much. Instead, we need a stable government who has a solid direction that we can actually trust will do more. Right now, that seems a big ask. But we're now 1 month past the election and the government needs to get going. In short, I believe we need a change in attitude in Canberra, not a change in interest rates. So what happened in the Australian market this week? The All Ordinaries Index opened at 6,699 points and moved up, breaking out of the sideways move that had unfolded over the prior 2 weeks. Now the miners kept the All Ordinaries Index afloat as iron ore broke US $120 a tonne, and as a result BHP, Rio and FMG were all up this week. The banks pulled back following their strong rise over the past couple of months, with the financial sectors flat. CBA was hit hardest, down around 1.5%, followed by Westpac and ANZ, who were slightly in the red. Now, the decline in the financial sector is likely due to a slowing in their momentum, given that the banks have risen consistently since the start of the year. That said, there was not a lot of support for the sell-off, so it's likely investors were just locking in some profits with concerns about the future implications of more rate cuts affecting the bank's bottom line. The best sectors for last week were utilities, which was up 4%, and information technology, not far behind it. These two sectors, along with consumer staples and healthcare, will provide the best opportunities that will see the market move up in the next month or so. Now, the best performing stocks in the ASX Top 100 were CYBG, which was up over 9%, with Nine Entertainment up over 7%. Again, there are a few property stocks in the best performers last week. However, I'm not convinced the rise in this sector is sustainable longer term. Aristocrat was the worst performer, down over 3%, although I don't believe there's anything to worry about for shareholders here. Brambles was also down nearly 2%, and energy companies Oil Search and Woodside were also down around 2%. So what do I expect in the market moving forward? Well, let's get into our charts for the S&P 500 All Ordinaries Index update for this week. We'll also answer your questions and look at the stocks you've chosen for me to analyse.
Please remember that this report is an educational tool While Wealth Within holds an Australian financial services licence, the information featured in this program is general in nature and therefore should not be relied upon. Before making any investment decisions, you should consult a licensed professional who can advise whether your investment decisions are appropriate for you. We hope that you enjoy this week's report.
Wasn't it an exciting week last week on the Australian market with a beautiful strong bar and a lot more confidence coming into our market, so we move out of that sideways move that I've been talking about for the last couple of weeks. I do think it's now pushing through to make that new all-time high, probably a little bit later than I expected with the sideways move that happened a little bit. It wasn't a major sideways move, but it just a little bit of slowing in momentum, which can happen around an all-time high or a major resistance levels that sometimes stocks will slow down a little bit when they're reaching near or previous all-time highs or significant resistance levels. But right now I think it's going to break right through. So looking at the chart, if I put my glasses on, you can see just above my pointer there, that 6873, that's coming off the all-time high way back in 2007, and you can see how close we are to that. We close, if I put my pointer on there, says 6831 was where we actually closed for the week. So we're getting really close to breaking through that all-time high. Now, I'm thinking that we should be going up into that 7259 sort of area, or 7,200. We'll get close to it before we have our peak and then start to move down later into the year. As I've been saying, I'm looking at the market having a low sometime around August, September, possibly into October. It just depends on where the high happens, how long we take to make the high from here, whether it's another couple of weeks or whether it's 4 weeks. So that will determine where the low actually comes into it. But if I put my little tool on, we can see if I put it on the close for last week, we're seeing it's only like around 6 to 7% to that sort of level. So it's not inconceivable that over the next 2 to 4 weeks, our market will move up close to that level if we can continue to move up. Now, looking at the bar, it was quite a strong bar there for last week. You can see really opening on its low, really pushing up. And we should see the same type of thing happening this week. Although I do expect 1 week down. We've had 1, 2, 3, 4 weeks up, basically. One of those, it closed lower, but it didn't trade lower. We may see 1 week down here and then another 3 or 4 weeks up to break up into that level. So if we do go down this week, not a big issue. If we go up this week and down next week, again, not a big issue, but I'd suggest that we're generally going to be going up through the end of July, possibly to mid-August roughly, and then coming down into our yearly low from there. So everything looking fantastic at this point in time. As I said to you in the early part, the sectors that I like, so there should be some good opportunities in those sectors. Second half of the year, I do like the banks coming towards the end of the year, so this could be a really good opportunity for them to come off a little bit and to pick them up a bit cheaper as well. So stick those on your watch list. But let's go into the questions now. And the first question I've got comes from Reload Antidote. He says, "How you going, Chief? Absolutely froth your vids, mate. Would love a detailed analysis of Freedom Foods or FNP from you. Would mean the world. Love, peace, keep it cool." Fantastic. I don't think I've had a question like that in terms of how that's written, but fantastic. I'm glad you love our videos. But I'll get into Freedom Foods right now. I'm not going to give you a super detailed one. It's always going to be a high level one. To me, a detailed analysis for me is where I spend 1 or 2 hours on it, not 1 minute on it or 1 or 2 minutes on it. But right now, we're seeing a bit of a bearish move in the current month, a slight move up here. It doesn't look as bullish to me, this stock. If I go to the monthly chart, I think it's getting a bit of resistance, and it's probably more likely to keep falling away and possibly go through that low. If I whack my little thing on here, you can see there's a bit of resistance across that level there at around 552. So right now we've had some indecision coming in through here into May. It closed lower in June, and so currently right now in July it's trading lower. So right now it doesn't look bullish to me. If you do own this stock, I think I'd be looking at an exit strategy on that somewhere. But right now I think it's probably further. It's quite bearish the last couple of weeks. Should it break through that level there at 472, definitely going down. So that's what I can say to you at the moment. That's my detailed look at it at the moment. So sorry, no good news for you. Now the next question comes from Dale Thomas, and he says, "Good evening, Dale and Janine. could you please review a BOQ or Bank of Queensland for me? Thanks. So let's click on Bank of Queensland there and have a little bit of a look at that. Again, another stock that's been quite bearish. A lot of the banks were bearish, as we know, for a long time. Back to March 2015, just like all the big four banks, falling quite heavily. But is it starting to move up now? Has it found a bottom, basically? And is it starting to move up? And you can see there, nearly 41% fall all the way down here into this low into February of this year. But it's found some support. We've had 5 months here where it has moved and it's gone up nicely, but this month's starting a little bit of indecision through there. So what's happening here is it started to move up and we've got a nice little rise, and I'll just bring up the weekly chart here. It started to rise up from this low back here in February. It's gone about 11%, not really strong. It's broken through this peak here at 952, suggesting it should be going up. It hasn't completely filled this little gap here, but a little bit of indecision in the last few weeks about whether it's going to rise. So I think right now it's probably stopped falling long term. I think that's what it's done. Whether it's starting to move up into a new, stronger uptrend or whether it's going to continue a sideways move, that's a little bit of a conjecture at this point in time. But for me to determine it's a bit more bullish, I really would want it to see it get above that 965, and not just above it, just push right through it, strongly push right through it. If you can do that, then there's plenty of upside on this stock. Now, one thing you've got to be careful with, a lot of people jump in really early on things like this, and they jump in early only for it to come back into the sideways move. And really, it's not about penny pinching with stocks. A lot of people trying to get into the lowest price or get out at the highest price, and that's fraught with danger and inconsistency. And if you've been watching our live show, you can look at the polls on our YouTube channel. You'll see that people are inconsistent. They're constantly saying, I'm inconsistent, I don't know where to sell, and they're inconsistent in their trading, and it's because they're penny pinching, basically. They're trying to eat the last few cents out of it, or get the last few cents out of the profit, or get in really early at the lowest possible time. I'd rather watch a stock move up and lose 10, 20, 30% off a bottom, know that it's going up, rather than jump in really, really early, hoping it's going up, if that makes sense. So trade on confirmation, not speculation. Looks all right, looks good for hopefully to move up at this point in time. I'm a little bit more bullish than bearish on it, so good luck with it. Now, the next question comes from Derek Duval, another great video. Thanks, Dale. Oh, thank you very much for that. Do you recommend any particular trading platform to your students? The answer is no. I mean, trading platform means broker. Obviously, the software we're using on the screen, Optima, that's what I use, but that's not a trading platform, it's software. He goes, I know some basic platforms don't allow stop losses, for example. You need to upgrade to their premium service. Cheers, Derek. Now, all we say to our students is just go to your bank. Whoever you bank with have got good trading portals. Now, I don't do any analysis on any platform. Neither does Janine, and you'll hear her say that in our live show. Janine and I do all our analysis on Optima, so do all of our students. Our students don't use platforms for anything other than placing a trade. I think what you mean, all platforms allow you to put a stop loss in, but you may be thinking about a guaranteed stop loss. If you're trading shares, just good shares, you never, ever need to put a stop loss into a platform. You just write it down, whatever your stop loss is, and should your stock trigger that, you get out of it. The only time you want to put stop losses into a platform is if you're going to be away or you're trading something that's highly volatile that you really need to do it. And, often most platforms do allow you to set a stop loss. If you want a guaranteed price to exit, then you might need to upgrade there. But I think, from most people on this channel are more beginners. You probably don't need to, but whatever your bank is, just open up a broking account with them. That's pretty much what I would suggest you do there. But yeah, you don't need to upgrade on all of that. But a great question. Thank you very much for that anyway. The next question we have is from Boris Marty. He says, TCL has had a nice run, although already have a stop loss in play. What's your thoughts on this run possibly moving up? To me, a newbie, last month's bar looks like it may continue its run. Still learning the share market game and trying to build some solid rules to buy in and sell out. Also learning what to look for to read stock better. So let's get on to TCL. Last month's bar is irrelevant in terms of the bigger scheme of things. It's just one bar. So That's the first mistake you do. A lot of people are looking micro rather than macro. Always look at the bigger picture, and you always see Janine and I have our monthly chart on the left, weekly chart on the right. Most of our analysis is done on the monthly chart. In fact, you'd be surprised at how much analysis Janine and I do on a monthly chart, and then we bring things down into the weekly chart. It's had a beautiful move up. We've had 1, 2, 3, 4, 5, 6, 7, 8 months up, and we're currently in the 9th month up. Have a look in the history of this stock. Go and count how many times it's done that in its history. Here we got 1, 2, 3, 4, 5, 6, 7, 8 months up. Can't see one here. 1, 2, 3, 4, 5, 6, 7, 8 months up. I don't think this run, looking at all the whole history, and this is why you look at the macro view, not the micro view, is you'll see it's quite steep too. The other thing that I look at is the momentum of it. If I put my little, just like using the trend line tool, looking at that steepness of that momentum, and if I can grab this trend line and look at that, see the same steepness there, but it's steeper than that point. Look at that, it's steeper than all of these actual points throughout here. So it's running really fast at the moment outside of there. And if we saw there, if I just delete that, that was 1, 2, 3, 4, 5, 6, 7. So we got 1, 2, 3, 4, 5, 6, 7, 8 in the 9th month. So to me, I don't know how long it's going to last, but right now, last month's bar wasn't an indication. It's actually indication a little bit more indecision to me. But right now, you need to have a stop loss in place, which you've said you've got, which is fantastic. Stick to your stop loss. If it goes down, it goes down. Right now, on the weekly chart, it still looks all right. Stay with it while it's going up, and that's the important thing. Too many people exit while the stock's moving up. In fear of losing their profits. Stay with it right now. That's a good sign for me. It's looking all right at the moment. When it starts to come down, enact your stop loss. That's really what I'd be saying to you there. But right now, it's looking pretty good. The next one's from Polo Cent. What does one who is caught by surprise by GFC do with the stocks they have that have crashed, sell or buy more? Well, we're now, 11, 12 years nearly past the peak of the GFC. Now, anybody who read my book, my first book, How to Beat the Managed Funds by 20%, on my best-selling book, they all missed the GFC because they were already prepared for that. There was no surprise about the GFC. They had rules around that and missed it. Again, if anybody read my latest book, Accelerate Your Wealth, again, you never have to worry about a crash, a GFC, whatever. If you follow the rules in the book, you will never ever get caught in a crash ever again, and you'll never have to worry about it. But if you've got stocks that you've bought or you had and they've fallen heavily and they still haven't recovered, I'm not sure why you'd still be in them. That's really my point, is when you've got money sitting in a stock that you've lost a lot of money on, and it hasn't come back to you, all you're doing is losing opportunity. And a lot of people won't sell because they've lost so much on some of these stocks. They might have bought terrible stocks prior to the GFC. They've fallen out of bed. They're down 80, 90%, and they haven't really recovered. And they're sitting down, and they don't want to sell because it's realising the loss. And that's a real emotional tug on a lot of people, about that, having that loss. I'd say it's like I was saying the other week, is, when you have a cut, your mum used to pull the Band-Aid off after it was healed pretty fast. She didn't leave it sit there or try and inch it off a little bit because it hurts more. Always look at what's the opportunity you're missing out on having money locked in the stocks that are not going anywhere. And if the stocks that you've got at the moment, if you had them prior to the GFC and you still got them and they're still not performing, I'm not sure why you're still holding them, but I definitely wouldn't be buying more. If they haven't performed now, they're unlikely to, and put them in better stocks, much, much better stocks. But really, really good question. Lastly, we have a question from, hopefully I can say this right, Chinthaka. He says, "Hi Dale, great work. This gives good direction to novice investors." Thank you very much for the nice compliment. I am too new to the markets. New to the market. What is your analysis on the following stocks? What is it better to start with, Metcash, MTS, or Telstra? I'm expecting around, looks like a 30-cent gain within 6 months. Now, I'm not sure why you're expecting a 30-cent gain in 6 months, but really, to me, if you're new to the market, you're just starting to get in, stick with the top 20 stocks. So without even looking at charts, I'd be going Telstra straight away because it's a top 20 stock. When you're new to the market, it's better to go for safe, big stocks because they're going to be a lot less risk for you. They're going to be a lot less management. And they're going to give you less headaches But let's go and have a look at Metcash first. I'll bring up Metcash on the screen here, and for some reason it doesn't show me the monthly chart for some reason, but let's look at that. I'm not sure why you want Metcash, but right now it doesn't look super strong to me. It's had a big huge bar down here, and it's still way below its all-time high, but doesn't mean it's going to move up again. But at this point in time, I'd be still staying out of Metcash. I'd like to see a little bit more signs. That worries me, this last bar here, this big bar here, that it is bearish. If it's more bullish, it shouldn't have fallen out of bed between the close of the week before. If I can get my pointer on it. Right down, it's fallen 18% in 1 week. That just shows the market's not really supporting it. This little bounce we'll see what happens this week. If it's sort of an inside bar, it doesn't go anywhere this week, then my suggestion is it'll probably fall out of bed, so I would stay right out of this stock at this point in time. But that said, my opinion might change on it in 1 or 2 or 3 more weeks. Now, I believe the 30-cent gain that you're talking about might be on Telstra, and again, that's a rookie error, if you want to say to me. If a stock's going up, it's going up. Don't worry about finding, saying, I'm expecting this or I'm expecting that. If it's going up, stay with it. Now, Telstra's going up. It looks like it's going to go up further. Stay with it. Have a stop loss underneath it and let it rise. Don't. A lot of people guess at how much the rise is going to be, and that's really fraught with danger, because they if it doesn't get to that, they keep hanging, and it starts to fall away. They keep hanging on, hoping it'll get to where they thought about it. So read my book, Accelerate Your Wealth, Your Money, Your Choice. Go online and get it, or go to the local bookshop and get it. It's the best $30 you're going to ever spend. It's going to teach you how to buy. It's going to teach you how to sell, teach you how to do the money management, your position sizing, how to construct your portfolios. Everything you need to get started, and it's the cheapest $30 you'll ever spend to give you the most amount of gain. It will make you thousands of dollars, and I know it will do that because I'm getting so many people telling me that the first time they really understand the market a lot better, and they're doing much better returns. So just get on down to Borders or wherever you want, or the Demics or whatever, and grab the book, or get online and grab it, and we'll send it out to you. So, but that's it for me for this week. For now, hopefully the market, or I think the market's bullish right now, so it should be exciting times over the next few weeks. But for now, goodbye, good luck, and good trading.